Before we begin, please support the channel by subscribing, liking, and sharing this video. Constructive discussion is always welcome, and we invite you to share your views and insights in the comments. Market analysis, tech movers, geopolitics, macro data, and retail trends.
This video presents a direct informational narration of the source document.
Looking at our agenda, we're covering 6 main sections today. 1. Market indices and tech. 2. Geopolitics and Boeing. 3. Middle East oil. 4. Macroeconomic data. 5. Retail speculation. And finally, 6. GOGL strategy. Let's dive right in.
Starting off with Section 1, Market Indices and Tech. When we look at broad market performance, the S&P 500's advance was driven by 300 constituent stocks moving higher. At the same time, the NASDAQ 100 showed a very clear overlap with the software sector, directly pushing the IGV software index up by 2%.
Now, looking at the major tech drivers, a stark contrast really emerges. Microsoft exhibited a lateral, low-volume consolidation. It edged up just 1%, with an identified target range between 498 and 516. On the flip side, NVDA executed a heavy volume breakout, surging 4%. To put NVIDIA's sheer momentum into perspective, that single stock accounted for exactly half of the S&P 500's total gains. Moving right along to Section 2, Geopolitics and Boeing. Transitioning over to geopolitical developments, the recent US-China summit yielded a generally positive atmosphere. This resulted in an invitation for a September 24th visit to Washington. Alongside these diplomatic steps, the U.S. Treasury Secretary mentioned potential tariff reductions targeting $30 billion specifically in non-critical areas.
Staying within this geopolitical context, there have been unconfirmed media reports suggesting that the U.S. has approved Chinese companies to purchase NVIDIA's H200 chips, but we absolutely have to treat this with caution. NVIDIA's CEO has explicitly stated that this news lacks official verification. Another major focal point from the summit involves aircraft orders. It was agreed that China would purchase exactly 200 Boeing planes. Now, this specific number actually acted as a negative catalyst from the market. It triggered Boeing stock to drop 4.73% for the day, which marks its absolute largest single-day decline since October. The market's negative reaction makes a lot more sense when we look at historical aircraft orders. That 200 plane order fell significantly short of the expected 500. For some historical context here, the 2017 order achieved 300 planes, and recent competing orders for Airbus reached nearly 400. Because of this disappointing data, Boeing stock failed its breakout attempt and executed a U-turn, dropping to test support levels at 226, along with its moving average support sitting between 219 and 220. Let's shift gears to Section 3, Middle East oil transport. Here, we have a vital update regarding maritime shipping through the highly critical Strait of Hormuz.
Based on shipping tracking data from Bloomberg, since May 10th, 4 supertankers, each carrying 2 million barrels, have successfully left the strait. Additionally, Iran permitted 30 Chinese ships to pass through safely. So while movement is definitely occurring, it's important to note that the daily transit volumes still remain far below the pre-war average of 20 vessels per day.
Section 4 brings us to macroeconomic data. Let's focus in on a few key macroeconomic metrics right now: inflation indicators, trade prices, and initial jobless claims. Looking straight at April's trade data, import prices rose by 1.9%. Now that figure was heavily driven by a massive 116.3% surge in fuel costs. Export prices demonstrated some strength too, increasing by 3.3%. Meanwhile, the labor market showed a slight cooling effect, with initial jobless claims rising to 211,000, coming in just above the estimated 205,000. Breaking down the 0.5% overall retail sales growth for April exposes some distinct consumer trends by highlighting the winners and losers. The sectors driving growth were electronics, up 1.4%, online sales, up 1.1%, and gas station sales, which jumped 2.8%. On the downside, expenditure contracted in furniture, dropping 2.0%, and apparel, which fell 1.5%.
On to Section 5, Retail Investor Speculation Trends. Right now, we're seeing a highly rare market divergence. The S&P 500 is hitting record highs at the exact same time that the number of individual stocks hitting 52-week lows is also increasing.
This rare market behavior is heavily influenced by retail trading volume. Data from Goldman Sachs indicates that retail investors hold $12 trillion in equity. That's roughly 10% of the total market cap, yet they're driving a disproportionate 20% of the total trading volume. And this high frequency is really amplified by leveraged products. Retail is utilizing 1x ETFs at 11%, 2x leveraged products at 14%, and 3x leveraged S&P products are comprising a massive 19% of the volume distribution.
This high-volume speculation isn't just random either. It specifically targets equities with highly distinct traits. The speculative volume is aggressively directed towards small-cap stocks, high-volatility names, high-valuation equities, and stocks with high short interest. To illustrate the eventual outcome of this specific type of leveraged speculation, we really only need to look back at GameStop in 2021. The asset saw an unbelievable 1625% explosion in January, which was then followed immediately by a devastating 68% collapse in February. Finally, we reach Section 6, Google Valuation and Strategy. Let's look at a conditional portfolio strategy, specifically zeroing in on the valuation modeling for Alphabet, GOOGL, which is tied for a 6% allocation weight within the strategy. The forward estimates map out Alphabet's valuation trajectory very clearly. The 2026 range is projected between $255 and $383, with a median of $313. Moving out, the 2027 range sits between $279 and $419, with a median of $349. The absolutely crucial point here is that the current price of $397 is approaching the 2027 upper bound prematurely. Because of this accelerated pricing, a very strict if-then conditional strategy is outlined for Google. Step 1. If the price tops $400, reduce the allocation weight by 2%. Step 2. If the price breaks the $375 support level, the target is to repurchase under $340 to effectively capture that excess short-term valuation. To wrap up the asset review, TSMC remains a maintained component within the strategy, also tied for that same 6% weight, with no immediate changes planned. To conclude this analysis, we're left to follow the evidence and consider a final thought. How might changing inflation metrics and these aggressive retail speculation trends ultimately alter the fundamental trajectories analyzed in this document?